What's up, everyone? This is Eric with Theme Options Trading, and today we will bust trading myths and discuss the basics of options.
The first thing we're going to talk about are options trading myths. These are things that I heard before I started trading, in the beginning of my trading career, and even now. And when I first started trading, it was extremely discouraging to hear these things because I believe them. However, the longer I spent trading, I have found that a lot of these things are untrue, and I want to break them. First, you have to be good at math to be a good trader. This is not true. If you approach the markets from a mathematical perspective, then yeah, you should be good at math. But if you approach the markets from a discretionary perspective, like I do, you do not need to be good at math to extract edge from the markets. Second, poker players and athletes make better options traders. No. Just because a person has mastered a craft does not mean they'll be good at something else. Yes, there are overlapping qualities that have made them good at poker or athletes. That does not mean that they have a passion for the markets. And this is a key element when it becomes to being a successful trader. You need to have a drive to keep pushing to better yourself. And that is stemmed from a passion for the markets. And this means that a poker player or an athlete may not necessarily have that passion. So that does not automatically make them good at options trading. You need 3 to 5 years experience to be profitable, and you will lose money your first year. If you do not have the proper training and you gamble the whole time, yeah, you will lose money your first year. Not only will you lose money your first year, you'll probably never be profitable during day trading, and you'll throw in the towel before that even happens. However, if you study the markets and you approach it from the right perspective and you put in the hard work necessary, you will not lose money your first year of trading. You might not make a lot of money, but you will be profitable and you'll learn a lot during your first year of trading. Fourth, 1% of 1% make it in options trading. You hear, oh, to be a successful day trader, only 1% of people make it. Well, if you want to trade options, only 1% of that 1% will make it. This is not true. If you use options the way that I do, it is not as hard as people make it out to be. Again, if you approach it from a mathematical perspective and you look at all this data, undervalued, overvalued, yeah, that's making options a little more complicated. The way I use options is strictly as a vessel to extract more out of the market with less capital. This is not as difficult as people make it out to be. Fifth, you need at least 30K to start, 25 to be over PDT, and 5K to trade with. PDT means if your account is under $25,000, you are only allotted 3 day trades during a 5 business day period. So, day trade meaning you enter and exit a position within the same day. I actually think being under PDT is extremely beneficial. It forces you to only take the best trades, and if you are emotional and you waste all your 3 trades in one day, yes, you get stopped out from blowing out your account, but also during that 5 business day waiting period, you're going to think about how your emotions prevented you from doing something you love to do. And the next time you get to trade, you'll keep that in the back of your mind. This happened to me. Under PDT, oh, yes, new week, 3 day trades available. All right, I'm excited to trade. Oh, this one against me. Let me try it again. Oh, this one against me. Let me try it again. Oh, this one against me. I'm out. I was done for 5 days. You better believe the next time I approached the trading desk, there was no way this was going to happen to me again. 6, making money in the stock market is hard. Not true. Making money in the stock market is actually pretty easy. It's keeping money in the stock market that is extremely hard. And this is where risk management comes into play. So, what is required from a technical aspect to be a successful options trader? Price action. You have to understand what moves stocks and how people react to these movements in stocks. And you also need to know how this price movement of the stock affects the price movement of your option. Third, themes. What is the theme of the market? What is the theme of this sector? What is the theme of today? What is the theme of this stock? These are all important components to make it in this field. And lastly, key levels. When I first started trading, you always hear support and resistance. These are very simple principles, but they are effective. But what I don't like about support and resistance is, oh, when you hear support, that means it's going to bounce off of it. You have a bias going into it. Okay, when it approaches this level, I think it's going to go up. But that will prevent you and has prevented me from taking a lot of trades. I realized I was really good at figuring out what a key level was. I would always say, if it broke this level, this stock is going to go up. But what I didn't consider was, oh, if it didn't break this level, this stock is going to continue going down. Had I approached these levels from an unbiased view, I would have a set risk in place. So, oh, look, there's a key level. There's my risk. If it breaks this key level, that proves my thesis wrong. And it took me a long time to realize I was missing out on a lot of trades because I always entered a trade or a day with a bias. Being unbiased during trading always gets you a really long way. So let's talk about options. An options contract is a contract for 100 shares. So anytime you see the price of an option, multiply it by 100 or move the decimal place right twice. So there are two types of options, a call option and a put option. A call option gives the buyer the right or the option, yes, pun intended, to buy 100 shares of a stock from the contract seller at a specified price. This specified price is referred to as the strike price on or before a specified date or the expiration date. Yes, these contracts expire. So there's a buyer and a seller. The buyer has a debit on his or her account. They pay money for the contract, and the seller receives a credit from the buyer. So they receive money. Put option. Put option gives the buyer the right to sell 100 shares of a stock to the contract seller at a specified price on or before a specified date. Right is highlighted here intentionally because that means if your contract expires, you can exercise it and say, yes, I want to buy or sell 100 shares of this stock at this strike price, or you don't have to. That in itself is a full topic, which I'm not going to get into. Greeks. This is the bread and butter of options, are Greeks. They are theoretical values, though. Theoretical is the key word there. And I'm going to do a whole other episode about Greeks in day trading. First, delta. For each dollar move in the underlying, how much does the option price change? Delta is the sensitivity of an options price to the underlying. And assuming you are a buyer of the contract, this number is 0 to 1 for calls and -1 to 0 for puts. Gamma. For the next dollar move in the underlying, how much will the delta price change? So this is what makes an options contract price nonlinear. So it is not a one-to-one movement with the stock. So gamma is the first derivative of delta, and assuming you are a buyer of the contract again, this value can range from 0 to 1. Puts and calls should have the same value. Vega. How does a 1% change in implied volatility affect the option price? So real quick, implied volatility is the expected future price movement derived from options prices. So options prices determine implied volatility. So implied volatility is essentially an emotional radar. Are people overpaying for options contracts? If the answer is yes, implied volatility is going to be high. Are they underpaying for options contracts? Are the contracts cheap? If they are, implied volatility is going to be low. So one example of when implied volatility is high is during earnings. There's a lot of uncertainty around that, so of course options prices are going to be high. Vega is the sensitivity of an options price to changes in implied volatility. And assuming you're a buyer of the contract, it is positive for both puts and calls. And lastly, theta. Theta is the loss of the options price or premium daily. So theta is negative for both puts and calls and is referred to as rent because options are decaying assets. There are some secondary Greeks, but they're not as popular and I'm not really going to get into them. So let's talk about intrinsic versus extrinsic value. Let's assume a stock is at $100 and you are looking to buy a call. So you have a call contract that has a strike price of $100. So the contract is the same as the stock price. So that means the contract is at the money. Let's say you're looking at a call contract worth $95. $95 is less than $100. So the option contract gives you the right to buy a stock at a specified price. That specified price is $95. If you exercise this immediately, you would have a profit of $5 because 95 is less than 100. This is not net profit, which is pretty important. If it was, everyone would just buy contracts that are in the money and make a profit immediately. There are other factors involved. And let's say you're looking at a call contract worth $105. This is out of the money because 105 is greater than 100. Okay, puts. Puts are the exact opposite. At the money is the same. A put contract at $100 and the stock price is at 100 at the money, but in the money and out of the money are different. So let's look at in the money first. A put contract with a strike price of $105 when the stock is $100, that is in the money. It's just buy low, sell high in reverse. So sell high, buy low. A 105 contract gives you the right to sell the stock at 105, but the stock price is at 100. So you sell for 105 and buy the shares back at 100. So you would make a $5 profit on the difference in the strike price in the stock alone. So this contract is in the money. And out of the money, or OTM, is the opposite. Let's look at out of the money, or OTM, a put contract at a strike price of $95. So 95 is less than 100. The stock price is not down that far yet. So this is out of the money. Okay, premium, or the option price, is intrinsic value plus extrinsic value. So let's look at an example of how we get this. Let's say the stock price is at $100 and we're looking at a call with a strike price of $95. The premium, or the cost of contract, is $10, or multiplied by 100, it's $1,000. And there are 4 days left to expiration, or DTE. The intrinsic value of the stock on a call contract is the stock price minus the strike price. The stock price is 100 minus a strike price of 95. That means the intrinsic value of the call contract is $5. Plugging this into our equation, the premium is $10. The intrinsic is $5. We don't know extrinsic value. Basic arithmetic, 10 minus 5. This call contract has an extrinsic value of $5. Tying it together, if this number was relatively high, that means we would be in a high implied volatility environment. If this number was relatively low, we would be in a low implied volatility environment. And out of the money options have no intrinsic value because if you exercise them, you will make no money on the difference in the stock price and strike price alone. Okay, so let's take a look at a basic options trading example. NVIDIA is $450 a share. We're looking at a call contract with a strike price of $470 with 3 days until expiration. This contract is $1.50. And we're looking to place a $1,000 position on this. So we could buy 2 shares of NVIDIA for $900 or purchase 6 contracts for a total of $900. The Greeks, a delta is 25 cents, gamma 1 cent, theta negative 50 cents, and vega 15 cents. Okay, NVIDIA has moved in our favor and it is now priced at $451. Our call contract is now $1.75. This was driven by delta. The options profit is $150, and if we were just trading NVIDIA by itself, we would only have a profit of $2. And let's say NVIDIA has moved in our favor again to $452. Our call contract is now worth $2.01. This extra penny came from gamma. Remember, options contracts do not move one-to-one with the equity itself. So if we were an options trader, we would have a profit of $306 or 34%. But if we were trading the stock by itself, we would only have a profit of $4 or less than 1%. And this is one of the many reasons why I prefer trading options over equities. Yes, you could say, well, the person who was trading the option put on more risk. Yes, that is true. And that is why risk management is key in this field. And that's it. If you like this content, hit the like button, leave a comment, and subscribe to my channel. Or you can visit my website by clicking the link below. Until next time.